Investing is the most effective way you can build your wealth and save for long-term goals like retirement, or paying for college, or buying a house. The sooner you begin investing, the sooner you can take advantage of compounding gains, allowing the money you put into your account to grow more rapidly over time. Investing is an extensive topic, and that is why we divide the topics. Don't forget to check out our other videos as well, and please subscribe so you don't miss any updates. Risk tolerance is one of the first things you should consider when you start investing. When markets decline as they did in 2022, many investors flee. But long-term investors often see such downturns as a chance to buy stocks at a discounted price. Investors who can weather such downturns may enjoy the market's average annual return, about 10% historically. But you must be able to stay in the market when things get rough. Some people want a quick score in the stock market without experiencing any downside, but the market just doesn't work like that. You must endure down periods to enjoy the gains. To reduce your risk as a long-term investor, it all comes down to diversification. You can be more aggressive in your allocation to stocks when you're young and your withdrawal date is distant. As you inch closer to retirement or the date you're looking to withdraw from your accounts, start scaling back your risk. Your diversification should grow more conservative over time so you don't risk major losses in a market downturn. Investors can get a diversified portfolio quickly and easily with an index fund. Instead of trying to actively pick stocks, an index fund passively owns all the stocks in an index. By owning a wide swath of companies, investors avoid the risk of investing in one or two individual stocks, though they won't eliminate all the risk that comes from stock investing. Another common passive fund type that can reduce your risk aversion and make your investment journey easier is a target date fund. These set-it-and-forget-it funds automatically adjust your assets to a more conservative mix as you approach retirement. Typically, they move from a higher concentration in stocks to a more bond-focused portfolio as you approach your date. Our next topic: understanding your investment options. There are many new investment opportunities a brokerage account can give you. Stocks give you a fractional ownership stake in a business, and they're one of the best ways to build long-term wealth for you and your family. But in the short term, they can be tremendously volatile, so you need to plan to hold them for at least 3 to 5 years. The longer, the better. Bonds. Investors use bonds to create a reliable income stream, and by owning bonds, you'll generate less risky but lower gains than you would with stocks. Bonds tend to fluctuate much less than stocks, making them ideal for balancing out a portfolio of high-octane stocks. Mutual funds. A mutual fund is a collection of investments, typically stocks or bonds, but sometimes both, that is owned by many different investors. You buy shares in the fund, which is often diversified among many investments, reducing your risk and potentially even increasing your returns. A mutual fund is a great way for inexperienced investors to earn significant returns in the market. Exchange-traded funds, ETFs, are much like mutual funds, giving you the ability to invest in stocks, bonds, or other assets. But they offer a few benefits on mutual funds. ETFs tend to have very low management fees, making them cheaper to own than mutual funds. Plus, you can trade ETFs during the day like a stock. And of course, ETFs can deliver significant returns to even novice investors. In our last topic, we're breaking down how you can balance long-term and short-term investments. And we have a not-to-miss bonus tip at the end of the video for you. Your time frame can change which types of accounts are most effective for you. If you're focusing on short-term investments, those you can access within the next 5 years, money market accounts, high-yield savings accounts, and certificates of deposit will be the most useful. These accounts are insured by the FDIC, so your money is going to be there when you need it. Your return won't usually be as high as long-term investments, but it's safer in the short term. It's generally not a good idea to invest in the stock market on a short-term basis, because 5 years or less may not be enough time for the market to recover if there's a downturn. The stock market is an ideal vehicle for long-term investments, however, and can bring you great returns over time. Whether you're saving for retirement, looking to buy a house in 10 years, or preparing to pay your child's college tuition, you have a variety of options. Index funds, mutual funds, and exchange-traded funds all offer stocks, bonds, or both. Getting started is easier than ever with the rise of online brokerage accounts designed to fit your personal needs. It's never been cheaper to invest in stocks or funds, with brokers slashing commissions to zero and fund companies continuing to cut their management fees. You can even hire a robo-advisor for a very reasonable fee to pick the investments for you. And finally, our bonus tip: avoiding easy mistakes. The first common mistake new investors make is being too involved. Research shows that actively traded funds usually underperform compared to passive funds. Your money will grow more and you'll have peace of mind if you keep yourself from checking or changing your accounts more than a few times each year. Another danger is failing to use your accounts as they're intended. Retirement accounts offer tax and investing advantages, but specifically for retirement. Use them for almost anything else, and you're likely to get stuck with taxes and an additional penalty. Your retirement account is meant to be used for retirement, so if you're using it for another purpose, you'll want to stop and ask yourself whether that expense is truly necessary. Because not only do you lose the gains that money could be earning, but you also must pay the loan back within 5 years, unless it's used to purchase a home, or you'll pay a 10% penalty on the outstanding balance. There are some exceptions to the 10% penalty, however. Do you want to know more about investing in real estate? Then watch this video. Thanks for watching and don't forget to subscribe.